Welcome to Talker Tickers. Today, we're diving into the latest third-quarter earnings from Sify Technologies. Now, on the surface, this Indian data center provider put up some really strong growth numbers, but the market's reaction, it told a completely different and, frankly, much more brutal story. So, what in the world happened here? Let's get into it. And this is the number that really matters. On January 13th, the day Sify dropped its results, the stock just cratered, falling almost 14%. And this isn't on some quiet day either. Trading volume absolutely exploded. So the big question is, what did the market see that so completely contradicted the confident tone coming from management? That really brings us to the core conflict of this whole thing. Is Sify a key player in India's massive digital infrastructure boom, just ready for explosive growth? Or is it a company that's just burning through giant piles of cash with a path to actually making a profit that's, well, way too far down the road? We're going to unpack both sides, starting with management's big bet. To really get what Sify is doing, you have to buy into their bigger vision. They are trying to become the essential digital plumbing for one of the fastest-growing economies on the planet, especially right now, as demand for things like AI and cloud services is just going parabolic. I mean, listen to how the company's chairman, Mr. Raju Wenna, put it on the call. This quote says it all, right? He's basically saying, the time for talking about potential is over. It's go time, and Sify believes they are right at the very heart of that action. And you know what? The headline numbers seem to back that story up. Revenue? A solid 11% jump year over year. But the real story here, the number that should have gotten investors excited, is the EBITDA. It surged 29%. That points to the business getting more efficient as it grows. And if we dig into where that money's coming from, you can see the engine of all this growth. Look at that. Data centers are now 40% of the business, making it their biggest segment. This is so important because it confirms Sify is all in on becoming a pure play on the red-hot data center market. And this slide right here, it just perfectly illustrates how intense the demand is. Out of the 130 megawatts of capacity they have ready to go, 127 are already sold. That is an insanely high utilization rate. It tells you that as fast as they can build these things, customers are lining up to buy. So to top off this whole bull case, there's a huge potential catalyst just around the corner. The IPO of their data center subsidiary, Sify Infinit Spaces. As you can see, they filed their DRHP. That's basically the first major step to go public in India. And management said on the call they expect approval this month. The whole point of this IPO is to unlock the value of that business and, more importantly, raise a ton of cash to keep building. So with all this good news, why the sell-off? Okay, now let's flip the coin over. This is where we shift from the exciting growth story to the numbers that probably gave the market a serious case of heartburn. And here it is, the whole puzzle on a single slide. For every positive part of the story, there's a really challenging financial reality staring back at you. Great revenue growth? Yeah, but they're still losing money. Sky-high demand? Sure, but it's funded by massive spending. A huge IPO catalyst? Weighed down by a profitability timeline that is still way off in the distance. Let's talk about that spending. Sify burned through over 3.4 billion Indian rupees on capital expenditures in just this quarter. That is a massive amount of cash going out the door. It's the cost of building out all those new data centers, and it's a key reason they're bleeding cash. And yep, despite that impressive growth on the top line, the bottom line is still deep in the red, a loss of 329 million rupees. It just shows that the costs to build and operate are still growing faster than their revenue. In fact, they reported an earnings per share of -1 cent, which actually missed the consensus estimate of 0. So the billion-dollar question is, when does this thing turn around? Well, during the Q&A, management said they hope to break even in the latter part of the next fiscal year, 2026 to 2027. For investors who are focused on right now, that is a long, long time to wait for a company to stop losing money. All right, so putting all of that together, what's our take on the company from here? Let's break down what we think is going to happen in the next quarter and beyond. For the next quarter, honestly, we expect more of the same. Strong growth on top, but those losses are going to stick around as they keep spending heavily. The stock price is probably going to be all over the place, reacting to any little piece of news or lack of news about that Infinit Spaces IPO. Getting that IPO approval is truly the make-or-break event everyone is waiting for. So here's how we're thinking about it. The bull case, it's crystal clear. Sify is in the right place at the right time, in a super high growth market. But the bear case is just as strong. There's a lot of risk they can't pull it off, the cash burn is massive, and that IPO, as critical as it is no guarantee. At the end of the day, their path to making money is still a show-me story. They have to prove they can do it.
So given this balance, this high potential on one side versus some very real risks on the other, our rating is market perform. This is basically a neutral stance. We see the long-term vision, we get it, but the financial pressures and the hurdles they have to clear in the short term just prevent us from being more bullish right now. The stock is likely to just move with the broader market until we get way more clarity on that IPO and their path to breaking even.
So, what's the big takeaway here? Sify is a classic jam tomorrow story. Great promises for the future, but investors on this Q3 call decided they just weren't willing to pay for that promise today. They focused on the losses and the cash burn that's happening right now. The next few quarters, especially whatever happens with that Infinit Spaces IPO, are going to be absolutely critical. This is not financial advice.